The impact of Federal Reserve decisions. The Federal Reserve's decision to adopt a more dovish stance during the Jackson Hole meeting is a calculated move that reflects a delicate balance between fighting inflation and avoiding a recession. Jerome Powell's speech clearly signaled that the Fed is prepared to start a cycle of rate cuts, possibly as early as September. And this is not just a technical maneuver. It is a response to a slowing economy, where signs of weakness have begun to appear in critical sectors such as real estate and consumption. This type of decision is rare and indicates an inflection point in U.S. monetary policy. Powell emphasized that while rate cuts are on the table, they will be guided by future economic data, which keeps markets in suspense and increases volatility. The implicit message here is clear. The Fed is willing to act aggressively, but only if economic indicators warrant such a move. Enjoyed this content? Then don't miss out on the other videos on my channel. I'm sure you'll find something that catches your interest. And if you haven't subscribed yet, make sure to hit that subscribe button and turn on notifications. That way, you'll stay updated with all the new content and help the channel grow even more. I'm counting on you. For financial markets, this dovish position has multiple implications. First, a lower interest rate outlook tends to stimulate risk appetite by pushing equity prices higher, especially in the most rate-sensitive sectors such as technology and consumer goods. Second, long-term bond yields tend to fall as investors adjust their expectations for future economic growth and inflation. This drop in yields could trigger an influx of capital into stocks and other risky assets, fueling a potential market recovery. However, this is a double-edged sword. While some see the prospect of lower rates as a catalyst for growth, others fear that the Fed's move will indicate deeper concerns about economic health, leading to a sense of caution. This uncertainty creates a highly sensitive market environment, where any new economic information can cause significant swings in asset prices. GBP/USD pullback potential. Reading market signals. The correction potential in GBP/USD is more than just a technical move. It is a window to understand the macroeconomic dynamics between two of the world's largest economies. The pound sterling, facing headwinds from the post-Brexit scenario, persistent inflation and political uncertainties, is in volatile territory. On the other hand, the US dollar is being boosted by a combination of potentially looser monetary policy from the Fed and an economy that, while still resilient, shows signs of weakening. When talking about a pullback in this context, traders are not only looking at a temporary pullback in prices, but also a broader reassessment of economic fundamentals. This potential trend reversal could be fueled by key economic indicators such as employment reports, inflation data, and policy decisions by the central banks involved. In addition, the analysis of the pullback potential in GBP/USD offers insight into how currency markets react to global uncertainty. A correction could be a buying opportunity for some investors, especially if they believe the pound has been overly penalized by fears of an economic slowdown in the UK. However, others may see this as a warning sign that economic conditions are deteriorating faster than expected. This tension between optimism and pessimism creates a dynamic trading environment, where accurate reading of charts and indicators can make the difference between a significant gain and a devastating loss. The foreign exchange market is by nature reactive and speculative, and the potential for a GBP/USD pullback in this context is not just a forecast, but an ongoing test of investor confidence in the short and medium-term economic outlook. Imagine what would happen if markets collapsed or soared overnight. What would be the impact on your investment portfolio if interest rates fell sharply or if the dollar and pound changed course unexpectedly? The answer may not be as obvious as it seems. That's why understanding every move, every speech at events like Jackson Hole is crucial. But the real question is, what will you do when the next unexpected move happens? How to prepare for these sudden changes shaping the economic future? And more importantly, why are these political decisions a strategic move that can determine the direction of your financial assets? Keep following, because the answers to these questions are more impactful than you might think.